everyone, welcome to Peaceful Investor. My name is Ricky. This channel is about simplifying investing and achieving financial freedom. Before I move forward, remember this content is only for educational purpose only and not a financial advice. Please do your own due diligence before investing. As few weeks ago, I posted a video on Portillo's Q2 earnings. We went through their revenue, profits, and the key highlights from the report. If you haven't seen that one yet, I highly recommend watching it after this video because it gives you a solid quarter by quarter view of how the business is performing. But today, I want to zoom out and look at the bigger picture. We are going to talk about Portillo's stock price, why it looks deeply undervalued at the moment, and why the future looks very bright for this company. As of today, Portillo's trades around $6.50 with a market cap of roughly 490 million. Now let's look at the valuation. And this is where things really get interesting. The price to sell ratio is just 0.61 times of the sale. That means if someone wanted to buy the whole company today, that would only be paying 61 cents of every dollar of revenue Portillo's generate in a single year. In other words, the company could theoretically earn back its entire value in just a little over 1 year of sales. That's how cheap it is right now. On the price to earn side, Portillo's trade at only about 14.4 times of their earnings. For every dollar profit the business makes, investors are paying just $14.50. Compare that many other restaurant and consumer chains that trade at 20, 25 or even 30 times of earning. And you can see the discount as massive. So from a valuation standpoint, Portillo's is clearly undervalued. Now let's step back to the IPO. Portillo's went public in October 2021 with share priced between $17 and $20. Fast forward to today and the stock trades at around $6.50, down about 63% from IPO highs. But here is the key difference. While the stock has fallen, this business itself has grown significantly. At IPO, Portillo's had just around 67 restaurants and today they have grown to nearly 90 locations, which is about a 33% increase in the number of stores they have. Annual revenue has climbed from around 510 million in 2021 to more than 730 million on a trailing 12 months basis, about 40% growth. So the fundamentals are stronger, but the market price is weaker. That disconnect is exactly what creates opportunity for investors. Looking at the most recent earnings, in the Q1 2025, revenue came in at 176 million, up 6.4% year over year. And although the net income dipped to 4 million, in the Q2 2025, the revenue was 188 million and they delivered earning per share of 12 cents, exactly in line with analyst forecasts. Margins are still thin, which is expected in a growth phase, but the company is profitable and continues to push revenue higher. So let's tie this together. Portillo's is just trading at 0.6 times of their sales and 14.5 times of the earnings. Those numbers are incredibly cheap compared to the broader restaurant industry. Think about it. Buying the whole company today would cost just 1 year of their revenue. You are paying far less per dollar of profit than you would for competitors. But despite this discount, the future looks very bright. Why? Because Portillo's is expanding aggressively. They are opening about 10 to 12 new restaurants every single year, which is roughly 10 to 12% annual growth in a store count. If they keep this pace for the next decade, the company could nearly double its restaurant footprint. Every new store adds more sales, more cash flow, and more brand recognition. And just like any other company, it's not risk free. There is always a certain risk. In the case of Portillos, if we look at the balance sheet, according to Q2 2025 data, total assets are about 1.55 billion and total liabilities are around 1.07 billion. That leaves shareholders with roughly 480 million in equity. When we focus on short term, the current assets are about $50 million, while the current liabilities sit at roughly 171 million. So, in the short run, Portillos owes more than it holds in current assets. That might sound concerning, but remember, this is common for companies in heavy growth mode. They are reinvesting cash into new restaurants and expansion projects. As long as Portillos continue to generate healthy operating cash flow and expand in revenue base, their obligations are manageable. Still, it's a factor to watch closely in upcoming quarters. One of the best signals long term investors watch for is what the company's own leaders are doing with their money. After all, nobody knows a business better than the people running it. And in Portillo's case, insiders have been buying shares, not selling. Over the past few months, we have seen multiple large purchases. The company CEO Michael Osnello bought around 13,000 shares at about $8 each. Director Eugene Lee purchased roughly 130,000 shares at the price of $7.68. The CFO, Michelle Hook, picked up about 40,000 shares, and the Journal Counsel Kelly Kager added about 27,000 shares. When insiders open their own wallet to buy stocks, it's one of the strongest signs that they believe the company is undervalued and its future is bright. This kind of conviction adds even more weight to the undervaluation story we have been talking about. And it's not just insider showing confidence. Wall Street analysts also agree that Portillo's looks undervalued. According to TradingView, the average analyst price target is between $14 and $15 per share, compared to today's price of just $6.50. That's more than 100% potential upside if analysts are right. What's important here is that this isn't just one optimistic call. The consensus rating across analysts is a buy. In other words, the people following the company closely believe that stock should trade much higher than where it sits today. Combine that with the fact that insiders are personally buying shares, and you have got both Wall Street and company leadership pointing in the same direction, confidence in the Portillo's future growth. So, to wrap it all up, Portillo stock is down more than 60% from its IPO, but the business has grown revenue by about 40% and the store count by more than 30%. The total assets sit at 1.55 billion against 1.07 billion in liabilities. Valuation multiples are extremely cheap with a price to sale ratio of just 0.61 times and a PE ratio of 14.5 times. The company is opening 10 to 12 restaurants every year, expanding its footprint steadily. Insiders are buying shares with their own money, and analysts on TradingView are targeting $14 to $15 per share, almost double today's price. Personally, I feel it's a high risk, high reward situation. I really like this business. I think it's undervalued at these levels, and that's why I currently hold about 5% of my portfolio in Portillo stock. For me, the combination of undervaluation, steady growth, and insider confidence makes this a long term story worth being a part of. Of course, this isn't financial advice. This is just my own opinion as an investor sharing my journey. Always do your own research before making any decision. Thanks for watching Peaceful Investor. If you enjoyed this breakdown, don't forget to subscribe and check out my earlier video on Portillo's Q2 earnings for more details. I will see you in next one. Thank you.